I got so many comments of you guys asking me to do a video on ISRG, which is Intuitive Surgical. The stock is down 33% over the last year. I was not planning to make a video, but I got so many requests and I decided to do it for you guys. So I really hope you enjoy it. Now, ISRG is a stock that's well known as a quality company and all these things. And I've been saying that the stock has been a trap for the last year, and I still believe the stock is some kind of a trap. I don't believe $345 is as cheap as a lot of you might believe, and I'm gonna tell you why. Now, ISRG makes the popular Da Vinci products, and those Da Vinci robots are well known as one of the best surgical robots in the world, and they have a dominant share in the United States, massive market share, and they're really good surgical robots in general. We talk about robotics a lot on this YouTube channel, and this company is a way to bet on medical innovation and medical robotics in general. They have over 11,710 installed robots in the world. About half of them are in the United States, and they have in Europe and Asia and other places. This installed base has been growing about 12% year on year. It has slowed down from the previous 20-25% growth, but it's still growing around 12% year over year, which is really amazing. Now, the best part about this business model isn't really the product revenue, which is pretty much the installed base whenever they install a new robot or install a new product, but it's actually the services revenue. Because if this product breaks down, if it needs a new bearing, if it needs a new maybe blade, if it needs anything that the robot needs, they have to call Intuitive Surgical, and they have to pay up for the parts because Intuitive Surgical is the only one that has those parts. So this is how GE makes a lot of money with the engines. If the Boeing engine goes out or something happens, you have to call GE to repair the engine because no one else can repair it. Same thing with the elevator companies and Otis Elevator. If something happened with the elevator, they're gonna double, triple charge you for services, and sometimes you have to pay it because no one else can fix it. So this is an amazing business model where the more robots they install, the more recurring revenues they're gonna have, not just from replacing parts, but they also sell a lot of systems that those robots operate on, and you can't have the robot and not have the system, and the cost of switching to another robot is normally very high. So if it's there, it's likely gonna be there for a very long time, and that's really amazing for the company. Now, why is the stock going down? It's going down for a few reasons. The first one, if you look at the company's revenue growth, it has pretty much flattened out over the last 3 quarters, even over the last 6 quarters. I mean, it has grown in revenues a little bit, but the revenue growth has been dull. It has been very slow. It's nothing like what the company used to grow at before. Part of it is because the company is getting a little bit more mature, you could say, even though the penetration rate is low, but it's more mature in terms of their products. But there's another reason why I believe the revenue growth is slowing down, and it will likely slow down in a major way in the future. And this is the reason why I have avoided ISRG for the last 2 years. And this is mainly from the competition of the Chinese robots. So in the United States, we have a lot of different rules and regulations where if we have a lot of patient data and other kind of critical data, a lot of those hospitals, they have to use a Da Vinci product. But the other half, which is the other 50% of those robots, are not in the United States. They're in Asia and in other places around the world, in Europe. And a lot of them are starting to adopt the Chinese robots. Not just because the Chinese robots can match the performance of the Da Vinci product, but it's because they cost as a fraction of the Da Vinci product. So the Da Vinci surgical system costs around $1 million after installation. The Unit 3 Chinese robots, they cost approximately $13,500. We're talking about $1 million versus $13,500. And I've seen other estimates of advanced Chinese robots about $50,000 or $60,000. So let's assume $50,000 versus $1 million. It's very hard to justify paying up $1 million for a US robot. If you're in Asia or if you're in Europe, you don't have such regulations. You could just buy the Chinese robot. You could buy 20 Chinese robots for the cost of one Da Vinci product. So it's getting harder and harder for the company to maintain the growth outside the United States. In the United States, it's still very robust, but more and more competition will come up from Chinese robots, Japanese robots, and most of it will take a lot of the market share that the company has, not in the United States, but mostly outside the United States. And this is the reason why I have been avoiding the company, because if you compare the cost to the Chinese robots, it's not even close. And they've been doing, I mean, this is in recent articles, they're doing a lot of surgeries, and it's very, very impressive, guys. And $13,000 cheaper than a car. Now, if you look at the company's multiple, it was trading at bubble valuations, guys. Like the stock traded as high as 70 or 75 times forward earnings. This was extremely, extremely overvalued. The average PE is 53 times. And now, even after this massive, massive decline, and after what I told you about the cost of the Chinese robots, it's still trading at about 30 times forward earnings. If you look at this chart, you're like, the stock should be trading in the 20s, 25 times. It's trading still at about 30, 31 times forward earnings. This is how expensive this stock has been. And by the way, I'm using fiscal.ai to come up with all those charts. If you want to try it out, it's give you 15% off if you want to use my link in the description. But 30 times earnings doesn't look cheap on the surface, especially if you look at the analyst estimates. They're expecting a massive deceleration in earnings per share growth from 20% down to 10 to 13%. So this is a massive deceleration, and the multiple is still about 3 times the expected growth for the company. But the analyst could be wrong, which is why I always use their case scenario as the base case scenario, or as you could say a bar, and I normally put it below the analyst estimate or a little bit above. But in this example, I'm gonna use estimates way above the analyst estimates just to illustrate how expensive the stock still is at the current price. Last year, they did about $8.93 in earnings per share. This year, they expected to do about $10.72. Then for the next 4 years, I put in 15%. I didn't put in 10 or 11. I put in 15%, which is above the analyst estimates. The trailing P on the stock is 39 times earnings. I used 30 times 2030 earnings, which I believe is still high. I think by 2030, it should be trading in the 20s, 23, 24, 25, 26 times earnings. But I'm using, again, the best case scenario, and I'm going to assume that it's going to trade at 30 times earnings. Now, using all those assumptions, I'm getting about 63% upside from the current price, or about a 10% annual return. That's it. Even after the stock is down so much, I'm getting about a 10% annual return. Now, if I want to get a double on the stock over the next 5 years, I would have to buy Intuitive Surgicals using those estimates at about $281 per share. And the stock right now is trading at about $345. And that's using, again, 30 PE. Let's say I want to use 25 PE because I think it's more fair. In this case, the upside is like 6% a year, and you'd have to buy the stock at $230. So I believe the stock is better valued than it was before. Like if I was dying to buy ISRG, I would maybe start a small position and dollar cost average down a tiny position. But I would not really call it some kind of a generational buying opportunity. I could be wrong, and maybe the market just holds 30 times because it's a quality company and takes it back to 50 times like Costco. But based on some pretty, reasonable numbers, I'm not seeing Intuitive Surgical as an amazing opportunity. I personally don't own it in my portfolio. I own another stock other than Ouster that supplies a lot of the arms and a lot of the bearings and a lot of the things that companies like Intuitive Surgical use, and is trading at about 14 times cash flow. So I much rather own those stocks than own a expensive company like Intuitive Surgical. And you could use AI to do a lot of the research and find those stocks, or you could potentially join my group and I share everything I do in real time. This is the link if you're interested. But that was my opinion on ISRG. I think under $300 per share, it gets very, very interesting. Above $300, it's, you could say it's like the best case scenario, and I wouldn't say it's a bargain. So that was my opinion. Hope you enjoyed it. It was not financial advice. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.